as you all know. So today we're going to be looking at introduction to what we know as our smart money concepts. Introduction to smart money concepts. I believe everyone has muted his or her microphones, please. I believe everyone has muted his or her microphones, and we've started recording. So we're not going to take a lot of our time because of those that are in the midnight. So some people will not sleep off whenever I'm talking, stuff like that. We should just use around 30 minutes and 40 minutes, then we should be done. It's just an introductory course. So today we're going to be looking at introduction to smart money. Okay, introduction to smart money concepts, because this concept is not, I won't say it's a new concept, but it's a concept that people are just seeing. I believe you can all see my screen. If you can see my screen, let me know. Don't unmute yourself, just type yes here so I can see it. If you can see my screen, type yes, or just type something so I know that okay, you are following me. Okay. There's some responses. Like I said, just mute your microphone, mute your microphone. Okay. Thank you for your time. Okay. That's enough. Right. So today we're going to be looking at what we know as smart money concept. And as I was saying, smart money concept is not something that is so new like that, but due to the fact that it is eye-catching, it has a lot of advantages. Yes, it has a lot of advantages. That's why people trade it a lot. We're going to be looking at the advantages in some minutes. But first of all, I'd like to let you know what smart money is. So what is smart money? Smart money is the capital that is placed in this forex market by institution or big investors. I call them the big boys or the big banks. This is the capital. This is the real money that
I'm
is
here.
injected into these forex markets by these big men. Who is this person? Who is this person?
Yeah. So
Okay. Money or the capital injected into these markets by the institution, big banks, hedge funds, and other financial professionals. Smart money also refers to the force that influences and moves the financial market. Yes, it is the force that moves the financial market, because when you're talking about smart money, that's where the whole money in forex markets is what is being moved, or the way it is being delivered or directed into. It is the movement of price from what's the injection by the big men, the big boys, the big banks, hedge funds, whichever name you want to call them, and often led by the action of the central bank. So, everybody wants to go in with the big boys, everybody wants to chill with the big boys, everybody wants to do whatever the big boys are doing. That's why everybody wants to trade smart money concept, because hey, if you know how to enter the market with the big boys, then that's very, very cool, right? Because you know exactly and precisely when the market is going to reverse, you know exactly and precisely when the market is going to buy or when the market is going to sell. That is why most people want to learn smart money concept, because it is very, very precise. So I'm moving now into the advantages of smart money concept. First of all, the precision. Yes, it is very, very precise. Whenever you are entering trades that are that will move immediately. You are not taking trades that will take your time. Maybe you are in a retail trader, and then you are waiting for a breakout, a retest, and then you know you are anticipating that okay, if I want to buy, the buy should be around this zone. When you're trading retail, you are not so sure exactly where and when the price is going to move. But whenever you're trading smart money, you already you already exact you're already exact wherever the price is going. That's why you always use tight stop loss. Another advantage is the tight stop loss. Stop losses of smart money is always very, very tight. Why? Because since you know exactly wherever the market is going, or wherever the market makers are going to move into, then why should your stop loss be so wide, like whenever you used to trade retail strategies? The reason we use wide stop loss on retail strategies is because we don't know exactly where the price is going to move to and where it's going to move from. So we always use wider stop losses. Like, okay, if the market should move around this place to this place. But when you're using start smart money, you are very, very precise that no, market should not give me a lot of rejection or reversal at my point of interest before movement or before the delivery of price. That is one advantage. You have what? Tight stop loss. And when you have tight stop loss, what does that mean? You know you can risk more and then your risk management is better, getting better every day. Another advantage is the risk to reward. Yes, whenever you are risking with small stop losses like 10 pip stop loss, 8 pip stop loss, 5 pip stop loss, 4 pip stop loss. Some people even use 1 pip stop loss and then they are using it to gain what? Let's say 53 pips at this point here. That is what? Risk to reward. What we have here, we have 1:7 already. So the risk to reward is very, very fine. Using 1 to get 7, unlike whenever you're using retail trading, whereby the price or the stocks is going to be very, very wide. So that's one of the disadvantage, rather advantage of smart money concepts. Next, we move to easy to get consistency. Yes, I got consistency trading SMC. Trading SMC. It was easier to achieve consistency when I started trading SMC. I was like, wow, 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 this is very, very beautiful. You know, SMC. When you know whatever you are doing, you know, sometimes when you're trading SMC, you get stopped out with stop losses a lot. So in the last class, which is on the 18th of this month, we're going to be talking about why smart money traders still lose money despite the effectiveness of the strategy. That is a very, very important factor to consider. But right now, we're still talking about the advantages, and the last advantage I have here is easy to achieve consistency, because whenever you're using this type of stop loss and this type of take profits, and whenever even if you're going to get a loss, you know, the losses should not be much. It should not be something that will affect you. So at that point, and you are getting the delivery of price faster, because with smart money, you should know exactly where the price is heading to and fro. Exactly with smart money. That is how you can what easily achieve your consistency. And again, you are doing the same thing all over and over again, all over and over again. As you can see here, as you can see my charts here, it's still the same thing, repetition of the same thing over and over again. So it is easier to achieve consistency faster that way. Now we're going to be moving into the terms, and I'll be showing you inside the charts. Okay, the terms would be liquidity, order block, demand and supply, imbalance, break of structure, mitigation, and then Wyckoff. Okay, so in these terms, I'm not going to really explain these terms, but I'll be explaining them on how to identify demand and supply in the markets, okay? Because those are the things we're looking into today, how to identify demand and supply in these markets. Uh, First term is liquidity. They always say if you cannot find the liquidity, then what? You are the liquidity. Okay? If you can't find the liquidity, you are the liquidity. What is liquidity? Liquidity is an area whereby is a target area actually. Liquidity is or liquidity, yeah, liquidity is an area of what targets. It's like a point of interest whereby there's a lot to happen on that zone. Either to take a lot of people out of the markets or to engage a little amount of people in what the delivery of price. What do I mean by engage little people in delivery of price? The little people are what the smart money traders that are what that are going to be engaging in the delivery of price whenever the market is moving. Whereas it's going to take out some people, those that trade the support and resistance, because liquidity is created and you know they want to take their money out. What is liquidity? Liquidity is stop loss. And what is stop loss? Your stop loss is money. Yes, liquidity is money. Money is liquidity is stop loss. Stop loss is money. Liquidity is an area whereby uh traders tend to what to target a lot. For example, I'm talking about retail traders now. For example, we can have areas like this support and resistance area. I'm sure those that are not newbies will understand what I'm talking about. Areas this is an area of liquidity because this is an area of interest already like this. There is an area of interest here because there's a lot going on there, and we term that as what liquidity. Yes, we term that as liquidity. As we move in into this um class, we're going to be talking about liquidity graph. Okay, so liquidity is an area whereby there's a lot of buyers and there's a lot of sellers, and according to retail, most retail traders sell at support, sell at resistance, then buy at support without proper knowledge. I'll say without proper knowledge because support and resistance strategy is more effective than what people think it is. Okay, when you use a strategy like Rajaban strategy, you know that man uses support and resistance a lot, and it's playing out. So people are using support and resistance the wrong way. Okay, now This is an area of liquidity here. This is a target area of liquidity because many people are looking forward to sell at this point, and then also market makers are looking forward to what? To take profits at this point. So what they do is they enter the markets once the market has gotten to this zone, because they know a lot of sellers will be at this point. Then what do? They grab the liquidity of those people and they later move in their direction. They grab their liquidity, meaning that they eat their stop losses and then moving in their direction. This is very, very common a lot whenever people are trading smart money concepts. It's very, very common. I'm sorry, when you are trading retail trading, whereby you trade at resistance and then market sells a little bit, then goes away in your direction and comes back in your direction. What has market done at that point? Market has grabbed liquidity because there's a lot of money resting here. A lot of people have sold here, so there's a lot of money here already. There's a lot of orders at this point. Orders are happening, orders are happening, orders are happening, and then they take you out, because once they take out all your orders, eating your stop loss, what's going to happen? It's theirs already, and then they can move the market into your direction, because at this point they also don't want to lose by continuing going up. If they actually want to grab liquidity, yet then they move in their in the desired direction they actually wanted to move before, and you are already the liquidity at that point. That's why they said if you can't find the liquidity, then you are the liquidity. The second term I have here is what? Order block. Okay. Now, what is an order block? An order block is a sort of candle that was formed before a liquidity grab order was formed before an impulsive move. Let's bring this out. Okay. Yeah, another block is a candle that was formed before an impulsive move. What do we mean by impulsive move? Impulsive moves are the abnormal moves that happen in the market, most especially sometimes after liquidity grab or after break of structures. What do we understand by break of structures? Now I'm moving into break of structure because I'm trying to explain the other block. Now, break of structure occurs whenever the market is breaking a structural high or a structural low. If we have a trending market, something like this. Now, from what we can see here, there's a break of structure here and here also. You can see that there's a breakout of this structure here. This is a uptrend, so this is a higher high, higher low, higher high. So there's a breakout of what this previous higher high. That's what we refer to as what? A break of structure. Let me put BOS there. Let me use 14. Yeah, so we have break of structure. That's what we know refer to as what a break of structure. That's a structural breakout of a breakout of what? A structural area. That's what we mean as what? Break of structure. When you consider that market is moving structurally, series of lower highs and lower lows, and then there's an impulsive moves. There's an impulsive move that was that break structure. That break structure. You can see. That's what we remember. That's what we term to as break of structure. And now we move to the term imbalance. Imbalance is the aggressive moves or aggressive move that is breaking a particular structure. You can see everything is coming together. Everything is coming together now. Imbalance is the aggressive move, something like this. You can see these sort of candles, these long candles, which is not formed during news. Imbalance can also be caused by news, but most of the time when there is no news and when we're trading smart money, these long candles here that are not formed by or caused by news are also referred to as what? Imbalance, because there were a lot of orders here. We believe that for there to be imbalance, it means there was a lot of orders at this point that broke structure to the upside there, whereas giving us what we know as what the order block can do before the break of structure. Okay, before the break of structure. Yes. So order block candle is the last down candle or the last red candle before the break of structure or before the imbalance. So same thing here also. It is was the last red candle or the last down candle before the what? Break of structure. So same thing for a downtrend also. There's break of structure and this order block candle that was formed before the break of structure. And that's the break of structure there. Okay, see, break of structure. So the imbalance caused the break of structure. The imbalance is what causes a break of structure. Imbalance is what causes a break of structure. Okay. Now I've explained liquidity right now. I've explained order block, which is the last down candle before the aggressive move to the upside. Imbalance is what breaks the structure, the structural high or a structural low. So we have this here also, break of structure here. Yeah. Imbalance also, imbalance here. We're talking about this, okay? That is the imbalance. You can see is imbalance is when there's a lot of orders in the market, a lot of orders, whereby there's a lot of buy orders than sell orders, or where there's a lot of sell orders than the buy orders. That we call imbalance, because the market is meant to be balanced and then moving up, down, up, down. But whenever there's imbalance, there's a lot of up move than down move, or there's a lot of buy move than sell moves. I believe you all understand what I'm talking about now. Whichever term do we have it now? We have mitigation. Then after mitigation, we have WYCKOFF. I'll be explaining WYCKOFF later because it's not under the contents of this course. So I'll be making a YouTube video especially for WYCKOFF, because people say WYCKOFF is a little bit complicated. So WYCKOFF wouldn't be part of this webinar, okay? But let me explain mitigation or return to order block. Now, these terms here are the terms I use whenever I'm trading smart money concept. There's a lot of terms that people always use, like COCH, that's the change of character. Some people always use inefficiency. Some people always use RTO. Some people always use there's a lot of terms, but simplicity in trading forex, in this forex market, all you need is just simplicity. You don't need to have too much of information before you can be able to execute trades. You just need a little bit of information that is very, very effective and that won't mislead you. That's all you need. Little bit of information that is effective and that won't mislead you, plus your psychology, and then plus your risk management, then you are good to go. But I don't know why some people still be trying to learn smart money concepts. They are learning a lot of terms, a lot. Some people even join indicators. Some people use different things, and then they confuse themselves. It's just always too much, which is not advisable. So left to me, I only use all these terms here: break of structure, because everything is happening right in front of us in the market. We have liquidity because we can see the liquidity here. We have imbalance, which is caused by what a lot of orders that will give us a break of structure, and then the other blocks. Okay, other block is the up move or the down move before the break of structure, and the last one is what's mitigation. Now the idea behind this mitigation is, okay, mitigation is also same as when market returns back to what an order block, to mitigate it or to retest it, and then what finally move in the desired direction, like that. Come back to mitigate it, and then continue moving in the desired direction. Okay, that's the meaning of mitigation. Is also the same as return to order block, wherever you are expecting when you've seen a break of structure, everything is set and in balance, then you are waiting for, okay, my entry should be back on the other block that was formed before the break of structure. Why do we want to enter at the other block that was formed before the break of structure? This is the reason, because we believe that if there is an imbalance, that means there was a lot of orders that broke structure, right? And before the orders were released, like before the orders were pumped, or before, whichever English you want to use, before the orders were released, like before the whole orders or imbalance happened, we believe that there's a candle that we call the order block candle that was formed before the break of structure that brought the imbalance. So it means there's still a lot of money on that order block candle that markets might retest and then continue to sell due to what? Due to the loads or tons of money that was still left there, that was remaining. Okay, there's a lot of money here, and then we're expecting market to go back to mitigate that zone and then sell. So why are we expecting market to sell? We're expecting the market to sell because there were a lot of sellers here, and we know that once the market comes here, there should be a lot of sellers here also trying to what? Use the remaining money here to what? To continue the sell movements or the sell direction. So same thing for buy also. For there to be an imbalance, we believe there was a lot of orders that caused the break of structure, causing imbalance. Then if market should come back to mitigate or retest it, we believe market should still move up. If it actually wants to, it should actually move up because there was a lot of orders here that are still left, and then markets can mitigate it to continue pushing prices to the upside. That's the idea behind mitigation, and that's why we always want to buy or sell at every candlestick. That causes mitigation, which is the other block candlestick. Okay, network is bad right now. Trying to reconnect. Yeah, I was explaining mitigation means return to what? Return to the other block. Yeah, so that's what smart money traders use to look for what entries in these markets. Because if you want to enter the market, you want to enter where there was a lot of orders left, and then where you feel okay, the orders are what's going to continue moving from. Yeah, so some examples are here. Let's quickly do some labeling. As we can see, so this is a structural move to the upside, and the break of structure here. This was the last sell candle before the move to the upside, as you can see beautifully here. And then this is what mitigation or return to order block, and you can see the delivery of price. So let me make an example for sell also. I really don't like this one. It's not so clear. Yeah, we have beautiful ones like this. Break of structure, because you can see this is structurally what bearish up to this point, and we should know that what market is trying to create a lower high. The price of creating a lower high mitigated this beautiful order block that was here, and then continue delivering price up to this point. So that's just a little illustration that I have for you. And same thing, I'm also expecting here impulsive move. You can see the impulsive moves that broke the structure. This is a structural high here, broke it out, broke it out. That's the break of structure, impulsive move. Other block candle that was formed before the move. And I'm expecting a mitigation at this point to deliver price up to this point. No hard rule. There's nothing so hard about it. It's people that complicate things and use different terms. Hey. So WYCKOFF, I'll be explaining WYCKOFF in just a jiffy, maybe in just 2 minutes, because WYCKOFF is more complicated than it seems. So WYCKOFF is the delivery of price from a bullish trend to a bearish trend, or from a bearish trend to what back to a bullish trend. We call this accumulation and distribution. Distribution is whenever market is planning to sell, while accumulation is when market is planning to buy. Don't worry if you don't get this, just stay tuned. You're going to get a more detailed video on the YouTube channel. Now, before market sells or before market buy, we believe that market maker does some series of buying, a lot of ranging before the real movements. So in the process of giving us the range, we believe the market makers are doing something inside the range, showing us signs of what delivery of price inside the range before what market sells, or before market buys. Yeah, so something like this. Let me just use this as an explanation. You can see that before this buy to the upside, we had this beautiful range here before price started moving to the upside, and then before market started selling also, we can see this beautiful range here. Not really a range, but like a range before the delivery of price. So you can see the range before the delivery. So that's what we explain as Wyckoff. Wyckoff is the movement of price from whenever it wants to change hands from weak to strong hands. But they use Wyckoff when they want to, change the trend. We believe Wyckoff allow you to know that hey, market makers are about to what to change the trend, and you can join in with them in the delivery of price once you understand everything they are doing inside that range. Because Wyckoff has a lot of labeling. There's a schematic that you have to understand and know each and every possible move or each and every possible meaning of the range. But in the YouTube video, I'll make it very, very simplified. So even without knowing the exact information inside the range of the markets, you can easily get in the delivery of price. How can you do that? With the use of the highs or lows that are going to be formed. Okay, we're not here for Wyckoff, we're only here for other blocks, smart money concepts. We'll be explaining Wyckoff in another video. Okay, right. I have 31 people on this call, which is very, very beautiful and okay for me. The next topic on the flyer is talking about how to identify demand and supply. Okay, first of all, how do you identify demand and supply? You don't just go into the market and say, I want to identify demand and supply. This is my demand and supply. First of all, let's go to a different or fresh pair. Which pair do I not trade? I don't trade NZD pairs. So let's just use NZDJPY. Now, how to identify demand and supply. Now, some people always say, this is when I always trade retail trading. You can see it's even I still have trend lines here, but we don't need that anymore. Yeah. Now, some people always say, what's the difference between oh god. Please mute yourself. What's the difference between order block and then demand and supply? Demand and supply zone is a particular zone that we look for markets towards to sell from. Demand. Okay, let me say supply first. Supply zone is a particular zone that we look at the market towards to sell from. While demand zone is a zone we look at the market towards to buy from. A particular zone. It's a zone, right? But order blocks is a specific kind of candle that occurs or that shows up before a break of structure or imbalance. Okay, this is the type of candle that is formed before a break of structure or imbalance. Whereas demand and supply, I can say this is a supply zone here. This whole sell area is a supply zone because it's a very, very big zone that market sold off from, and then I'll be expecting price towards get into this zone in the future, give me some sort of Wyckoff, and then continue what's delivering to the downside. That's a supply zone. I don't need any break of structure. I don't need any imbalance. It's a zone that market sold off from, first of all, and I'll be expecting markets to tap into it and then sell again. Understand what I'm saying? So this whole zone here, like this. Yeah, this was the O zone before the sell move. You can see this O up move before the down move. That's what we refer to as the supply zone. It was the O up move before the down move. Okay. And this here, so this is the demand zone here also. Now, how to identify demand and supply zones? We've identified them just like that using the daily time frame with the use of what? Turning point area. Yeah, the turning points area. Like this is a supply zone. Okay. So where's another turning points area again? It's just more is like support and resistance. Something like that. You can see this is an area of turning points. So same thing here also, area of what? Turning points. More like resistance, but it's more advanced than resistance and supply because this doesn't have to give you two support areas. Like, to confirm a support area, you need to have something like this and this to confirm that this is a support area. But for demand and supply, demand is just a single zone where the is a turning point zone where the market shuts away from, and you're expecting what a return to what to continue moving. So it's just like other block also, because it's me looking at this is like I've drawn another block here, but demand and supply, I don't need a break of structure and I don't need imbalance before I can say, hey, this place is a supply zone, or hey, this place is a demand zone. Now, that's how to first identify the demand and supply. Demand and supply zones are turning point areas where the market has was reacted to first of all, and then in the future you expect market to react again. Okay, that is the first way to identify the supply and demand in the markets, because we believe that okay, if there's a huge turning point at this point, then we believe that there's a lot of money also here that was put in the market at this point that made this market to sell off so hard like this. And in the future, when we are looking at other blocks, then we can now refine, and then we can say, okay, this is the other block I want to use on this supply zone. Now you can see the difference between supply and demand and other block. Demand and supply zone is the O zone that caused the turning point, whereas the other block is more like a refined demand and supply that you want to look for entries from. Okay, now that is the only way to identify demand and supply, turning point areas in the markets. Now, first of all, you don't just say, okay, this is a demand and supply zone, then, okay, let's say this is a demand and supply zone. Now, you can't say, I want to wait for market to tap into this zone, because it will take, this is the daily time frame, it will take a lot of days, you see? It will take a lot of days before market gets there. So all we need to do is, we need to follow structure and know what structure is all about. Structure is still the same thing as the movement of price or the order flow that we know, the way the price moves, upward trend or downward trend. I won't really dive into that right now because it's not for this free class, okay? But understand the series of lower highs and then lower lows. When market is giving you upward trend, you want to what? Buy low and sell high. So it means you want to what? You want to buy low. And where is this is what is this trend? What trend is this? First of all, we have an uptrend here. Now we have a downtrend here. Now it is what's trending up. So we want to what? Follow this minor uptrend we have here. Now you want to buy low, right? So where is a turning point area here as that we can use for a demand? We have markets rejected down from here. So this is a good demand zone, right? That's a reversal area, an area that market reversed from sharply. You can see we had a good move to the upside here, so we can say that that place is a what? Good demand zone, and market reversed from this point here. That's a very good demand zone also. Now you can see that these are demand zones that I have drawn out for you. So whenever you want to what? Draw other blocks, you can see I'm using the upward trend. I'm not using all these demand or supply. I'm not using this supply zone here, and I'm not using this supply zone here. I'm not using those because I'm in a uptrend, a minor uptrend on the 1 hour time frame, and I don't want to I don't want to confuse those newbies with what multi time frame. Yeah, that's multi time frame analysis where you're looking at the 4 hours, the daily, the 1 hour, and then the 30 minutes time frame for identifying demand and supply. I'm only using this 1 hour here, and I'm only using this upward trend here. Now you can see you are expecting what? A return towards this zone and then tap and then move up, right? But now this zone is very, very big. That is a demand zone because it's just too big. I don't know if markets will tap into it, let's say 50% or 100% before markets start moving up. So that's where the idea of what other blocks come in. Okay, now before we find another block, is there a break of structure? Yes, at this point there's a break of structure here. Beautiful. And is there an imbalance? You can see these candles are quite long enough. I will say that's an imbalance. And where's the last red candle before the whole buy move, before the whole break of structure? This is the last sell move, sorry, sell move rather. Where's the sell move before the break of structure? It was that red candle. Okay, now you can see how I've refined from this whole demand zone to this little demand zone. To be more precise, from where market is what market is going to react from. Okay. I won't want to use this one again because this one has mitigated already. This one mitigated the demand zone. Sharp. You can see this one. You can see this demand zone here is the other block also, but at this like this one, like just explained, the refined zone is what's the other block. Yeah, that's the other block. Now, some people always go down to the 30 minutes time frame to also check for the last candle before the break of structure, and still the same thing here also. I would like to take from the wick of the candle because that's part is also part of the candle. Some people also go down to the 15 minutes, they like refining. This is called refining. You can refine at your own risk, but to me, I don't like refining. I stop at the 1 hour time frame, so I don't really miss entries. You understand? Because when you over refine, you should understand that you tend to miss entries a lot. So these are the best possible ways to look for supply and demand zones in these markets. I won't want to complicate things and moving into much time frame analysis right now and then structure, then order flow. But this is the simple way to look for demand and supply. Look for a turning point in these markets. Look for a turning point in the markets, and you expect what price to move from there. Okay. Now let's use 4 hours for this one. Let's identify the demand and supply zone here. Let's use a better pair, please. GBP card. Okay, so where are the turning points areas? I'm looking at this bullish move here. So this is a turning points area here. Market moved up from this zone. You can see there was no break of structure, but market came back to mitigate it. Why? That's because it's a demand zone. So I'm expecting this mitigation also here. That's a demand zone also. See, we can also say markets can mitigate demand zone. Still the same mitigation, any English. You can see this is a turning point here. So I'll take this whole zone. That's the what demand zone. And then once you refine it, it should come to this other block. But this is the whole zone. You can see market mitigated that zone exactly 2 times before taking off. So you should understand the difference between supply and demand and other blocks. Yeah, so let's move to the 1 hour time frame. Now we're identifying the good reversal areas here. This is a reversal, the sell reversal here. This is the whole zone. Beautiful. Then you should look for your other block whenever you are planning towards enter. First of all, follow the structure. Second, look for what's the demand and supply zone. Then thirdly, you adjust the demand and supply zone to an other block can do. You understand? First of all, look for structure. Let me write it out. 1, understand structure. Either up, down, trend. Secondly is what? Then draw out the demand and supply zone. Then thirdly, when you want to enter, that is when you are looking for entry. Then you refine down to other block can do by what's looking for a break of structure imbalance. Break of structure or imbalance. It should be break of structure and imbalance. I think that's too much. It's too big. Yeah. So when identifying supply or demand zones, what's the first thing you need to look for? You need to understand the structure first of all. Either it is an upward trend or a downward trend. Draw out the supply and demand zones. What are the supply and demand zones? Those are the what? The turning point areas in the markets that give an aggressive sell or that give an aggressive buy, something like this. This is a good turning point, and that's a zone on its own. You can see market mitigated it fully and then it's still sold. And when you want to enter, you refine down to the other block. You can see now that when we refine this here, we got this sniper entry. We got this sniper entry. So this range or consolidation, we can label it as was WYCKOFF GBP card. We can label it as WYCKOFF because there's a lot of range here before the sell move, and then it even mitigated this demand zone stroke other block area and gave us WYCKOFF schematics, and then started selling up to the next demand zone again, supply zone, up to the next demand zone again, and we're expecting delivery of price. So this supply zone has been mitigated here. This supply zone has been mitigated. This demand zone has also been mitigated. And what should we be expecting from here? Let's see if price will break out from this zone. And we should know that there's a turning point area here also. You can use the candle here. You can use the two candles. You can use the two candles like this. You can use one candle like this. It doesn't matter. They are both what? Demand zones. Because all you need is just that, okay, since it's either their demand zone like this or like this, you know in your mind that you are still going to refine down towards to the other block candle that broke structure to take your entry. So either demand or supply zone. If it's confusing, you just know that, okay, you're still going to take your entries at the other block. But we're using demand and supply to first understand the turning point area that's that the market reacted to, because we know that there's a lot of orders at that point. For the market to turn out or turn away from that point, then we should be able to see an order block from that turning point area by seeing a break of structure and imbalance.
But
Yes, so
we
we are
didn't hear.
yeah, okay. Sorry for the break in transmission. So we've covered two aspects on the flyer, which is introduction and then how to identify demand and supply zone. So tomorrow we're going to be moving into what is on the flyer. I believe it should be um, using order block for entry and something. I can't really remember. But if you have any questions, ask on the Telegram group. I'm going to answer you because the network might not allow me to answer you guys. Yeah, okay. So I believe you all learned something today, and I want to say thank you all for your time. 28 people on this call right now. Okay.
Boss, boss, I just want to ask a question that you can answer on the chat here.
Okay. I'm with you.
Okay, please, I want to know the difference of the other block, the one that we owed and the one that we not owed. You know, some other block, it will be a nice other block, but still it will not owed. Price will not mitigate it. So I want to know the one that will be mitigated and the one that will not be mitigated. I don't know if you understand my
No
question.
problem. Tomorrow is still the real due for answering this type of questions. Today is just like an introduction, how to spot, you understand how to spot, okay, introduction and then how to spot. Okay, then tomorrow is the why should this one hold, why should this one not hold? Okay. I believe I've answered your question, young man.
Yes, boss. Yes, boss.
Okay. So tomorrow, if I don't answer
Yes,
this
sir. I,
question,
I also have
you can probably ask.
the question, please.
Who's trying to ask a question? My system is low right now. If you don't have any question, then I think that will be all for now. I'll say peace, guys. I'm out.
Yeah.